So now that we've covered a lot of the basics that apply to all stocks, the next helpful step is to start exploring some of the differences between them. A great jumping off point for that is discussing some of the different broad classification systems for types of stocks. So no classification system will perfectly capture every nuance about any given stock, but it can provide a super helpful framework for understanding differences in things like risk and return potential, and where different kinds of stocks fit in with different investment strategies. So let's take a look at some of the most common classification types. So first, one of the most straightforward and common ways to classify different stocks is with something called market capitalization, also called market cap. Market cap refers to the total monetary value of a company's outstanding shares, meaning the dollar value of all of their shares combined. It's calculated by simply taking the number of outstanding shares and multiplying it by the current market price of those shares. This is the most frequent way you'll hear investors describe a company's size. That's because it's an easy, standardized way to compare companies across sectors and industries, simply based on the total value that they represent to investors. This size classification also provides some key insights into different things like risk and growth opportunities. For example, large cap stocks, or companies with a market capitalization greater than $10 billion, tend to be well-established, industry-leading companies. These are often household names like Coca-Cola or Walmart. Some of the benefits of investing in these large cap stocks are that due to their maturity, they tend to be more consistently stable and experience lower price volatility than many of their medium and small cap counterparts. Additionally, for dividend-focused investors, this is one of the best places to find high dividend yields. The trade-off here, though, is that because of these companies' size and maturity, they also tend to experience lower degrees of growth and capital appreciation relative to some of their small and medium cap counterparts. Small cap stocks, or companies with a market capitalization under $2 billion, tend to be things like niche firms or startups early in their growth stages. These companies often possess the potential for significant and/or rapid expansion, but also carry much more risk with them, given their lack of established track record. And mid-cap stocks fall somewhere in between these two. Although they've moved past the startup phase and have both more stability than small-cap stocks and likely more notoriety, with recognizable names like Etsy and Shopify, they also present more growth opportunities than many of their large-cap counterparts, while still experiencing more volatility. One of the next most common ways to classify stocks is based on the type of investment that they represent. One common one is described as value stocks. Value stocks are when a company's shares are trading at a price below what investors believe to be the intrinsic value of the company. The intrinsic value is the estimated true worth of the company based on fundamentals, such as profitability and financial strength, as opposed to the current market price of that stock. When there are mismatches between the market price and the assumed true value, that's when you have potential value stock opportunities. Two other common style-based classifications of stocks are growth and dividend stocks. Growth stocks are sort of the opposite side of the same coin as value stocks. Whereas investors looking for value stocks are on the hunt for companies that are priced currently below their intrinsic value. Investors looking for growth stocks are often looking for companies that, even though they may be relatively expensive at the moment, Their intrinsic value is expected to grow at such a rapid pace that it justifies the current market price. Dividend stocks, on the other hand, are companies that regularly pay out a portion of their profits in the form of dividends to investors. These are typically well-established and financially stable companies. So much so that they typically have fewer opportunities for growth, which is why they distribute their profits as dividends instead of reinvesting them. This can be a key benefit for investors looking to invest in dividend stocks for the sake of developing a steady income stream in the form of dividends. The final category worth discussing, at the very least because you'll hear the terms frequently, are investment vehicles of stocks, which are baskets of stocks that allow you to gain exposure to multiple different companies with just a single purchase. The two main types are called mutual funds and ETFs. Mutual funds are essentially giant portfolios that you can buy partial ownership in, instead of buying partial ownership in specific companies directly. Mutual funds pool money from lots of different investors and then give that money to a team of professionals that then turns and invests in individual stocks. These stocks purchased by the management team then become the portfolio that the contributing investors are partial owners in. This does provide some benefits, such as allowing investors to easily diversify their portfolio across multiple companies, and allowing those companies to be selected by professionals. But there are some significant drawbacks. One of them being the significant fees charged by those professional management teams. These can eat away at the returns delivered to investors. The other major investment vehicle is called an ETF, or exchange traded fund. Unlike mutual funds, these are not actively managed portfolios, but rather a static basket of stocks. So they don't come with the same management fees that mutual funds do, but they don't provide the same benefit of being actively managed like mutual funds. So there's a trade-off there. But they do similarly provide easy diversification to a large basket of companies.